Do you just hate it when you hear that the stock market is in a bear market one week and then a couple weeks later, maybe a week later, it's no longer in a bear market, it's back into a bull market. And then it happens again, it reverses itself, and you feel like you have no idea where the price is of the assets that you own, whether that's stocks, bonds, or maybe even another type of asset relative to historically where it's been. And you have sort of lose touch of, is it near the high, is it in dangerous levels, where is it now? And when we take a look at where asset prices have been relative to where they have been historically, we can get a really good feel. It can help us see, are assets overvalued, undervalued, where are they relative to where they've been in the past. Hi, I'm Camille Gaines here and on my website, retiresurgeon.com. I write about and talk about investing. I'm not trying to sell you wealth management services. I'm not a financial advisor. I just like investing. I've been investing for about 4 decades. I've invested in just about everything except for crypto. And I like to talk about it here. If this interests you and you like my information after you see my video, make sure you subscribe to my channel. Click that little thumbs up so you know when I post a video. I think it'll come up in your newsfeed. Okay, so this tool, you already know, is a stock chart, and stock charts are nothing to be intimidated about. They're great, quick way to get a great perspective, a grounding on where an asset class is before buying it or while you're owning it, if you're concerned about where it is. Okay, so what I've done here is I pulled up a long-term chart of SPY, and that is the S&P 500 index, and this goes back about 20 years, and the 20 years ago is sort of hidden over here behind me. And so that was sort of the tail end there of the tech bust that we had in the early 2000s decade. But what we can do is scroll along here and we can see that we have the financial crisis bear market here, and we can see that we had another little bear market that was fast and not too dramatic here in the early 2000s decade. Oops, we're not going to change that quite yet. So we can see that we had that little activity here, and then here we are right now. Now I've got this, and let me show you, you can do this as well. And the way that you could do it, I'm actually using my Street Smart Edge platform at Schwab, but all you have to do is Google an ETF or exchange traded fund that represents an asset class that you own to do this yourself. And things will come up in the search results after you type that in, and one of them will most certainly be a chart, and you just click on it and then click on maximum. Usually it's MAX for time frame, and it will show you where that asset class is relative to where it's been in the past. It's so quick and easy. All right, so in this case, if you're wondering about stocks, you could type in SPY and you could even put in the word chart. If you own intermediate bonds and you're wondering how bonds are doing relative to where they've been in the past, you could type in IEF chart and take a look. For gold, if you happen to own any gold, most investors don't own gold or commodities, but if you happen to, you could type in GLD for gold to pull up that exchange traded fund. And for commodities, you could type in DBC. Just remember that that commodity fund is heavy in energy. So it's got a lot more, it's kind of weighted toward energy holdings. So it's going to be affected by the price of oil. Now, having said that, that's how you can do this yourself. And when you do this, you can do it at any given time frame if you're concerned about the gyrations of the stock market. And I like to just do it before I buy any asset to just get a really good feel for where the asset class is relative to where it's been in the past. I like to say it's like buying cashmere sweaters when they're on sale in April versus buying them in October or the week of Christmas. Okay, so I've got here as I mentioned, a long-term chart, and let me show you what you can do also in wherever you're looking. And this is a weekly chart, as you can see right here, but I can click this little down arrow and I can look at a daily chart or a monthly chart. If I look at a monthly chart, you'll see, and I've got this set up for candlesticks, so you can see these a little bit better versus the other type of little graph here was a bar chart. Okay, so if you take a look at the monthly, you'll notice this is fairly smoothed out. You know, it doesn't look, the moves don't look as dramatic. But if we take a look at the daily, and let me just zero in on that, we can see, wow, this is much more dramatic. That feels much more painful. So this is 479, almost 480 up here at the top, and then down here from this movement was about 364. So that was a very dramatic drop. And when we look at it on a monthly basis, it just, like I said, it doesn't seem as dramatic. Now we can do the same thing with a weekly, and we can see the differences. Now this, remember how that 2020 quick little bear market looked really kind of irrelevant? Well, here it is on a daily chart, and you can see that it's much more dramatic. We can see that that price move was really quite large, and so you can look at any time frame that you like. The other thing I want to point out on here, and let me go back to that long term, the monthly, and what I like to do is look at the volume, and we can see how high the volume was here in the 2008 bear market, that bear market that started in 2007, ended in March of 2009. We can see that the volume was really high here, and we can see here that it's much more contained, it's much calmer. And when there's a lot of volume, a lot of churning, that's a lot of institutional activities, buyers and sellers, and a lot of more, it's a sign of more uncertainty and volatility. Now, let me mention a couple things here. You can do this, as I mentioned, for any asset class that you own. Most investors own just stocks and bonds. The other thing is super important to remember is that the time frame for which you're investing is going to be different from the time frame that this is happening. Okay, this is the past 20 years, and I'm recording this in almost mid-September 2022. So the time frame here is going to be different from the future time frame, and we're encouraged as investors, and I also do use past return data to help me pick out strategies that I use for investing, assets that I use for investing, because that's all we have. It's really helpful to see, how did this strategy do during this bear market here? You know, how did this strategy perform here or here? That's helpful because we can sort of make an assumption that it will be similar when we have a similar circumstance in the future. This is super important. During this entire 20-year time frame, we've been in a broad interest rate decline. So that means that interest rates were behaving differently than they're going to behave over the next decade or two, simply because we're still low. The interest rates are still low relative to where they've been historically. So we have to keep that in mind. We also have to keep in mind inflation. This was during a period of low inflation, and we know now we've entered recently a period of high inflation. That will change. It all changes. And these economic factors are the things that drive your investment returns, not picking out the right stocks, not picking out the right bonds or the right financial advisor or the right funds. That's secondary to what's happening that will affect your investment returns. These are the things that affect your investment returns. Sure, it's important to get good funds, low cost funds, I always like to say. Sure, it's important to pick good stocks if you happen to be a stock picker. I'm not anymore. That's important, but the overall economic happenings, the things that are bigger, that's what affects your investment returns. And that is why I'm not a long-term buy and hold investor no matter what happens. I don't just put 20% here into stocks or into bonds and 80% into stocks or whatever it is, because I see that asset classes, sometimes they're overvalued and that's riskier, and sometimes they're cheap and they're lower risk, and I can buy more for my money. And that is a core financial principle is getting more for our money. We apply it at the grocery store. We apply it on the cashmere sweaters when they're on sale. We apply it to everything. But sometimes we forget it when it comes to our investments. So if you take a look at a chart, you can see where you are relative to where an asset class has been historically. Now, I'm not suggesting that you invest like me. You may be perfectly happy with an asset allocation, like I was mentioning, maybe 20% bonds or 80% stocks or whatever is appropriate for you. You may be perfectly happy with that for your investing. Most investors do invest that way. Most financial advisors invest that way. That is how the most commonly promoted way to invest. I just want to be transparent and say that's not how I invest. I'm not saying it's right or wrong. What I say is everybody has to figure out what works best for them. And the only way you can do that is if you first understand what your options are. You know the different ways that investing is done. You know how much they cost. You know the risk and returns that are likely or have been historically from those various ways. And then from that place, and while also considering what do you like, what do you want to do with your time? Do you like investing like I do, or do you just detest it, or have you just never gotten around to learning it? And once you determine that, then you can select what works best for you. And I think what ends up happening is investors just default to that common asset allocation model because it's so heavily promoted, and it's the way things have been done over the past 20 years or so, because it's performed beautifully without any work, because we had this going on and we had falling interest rates, which helps spur along stocks. It also increases the price of bonds because bonds rise when interest rates fall. So it's a beautiful time to have a simple asset allocation model with stocks and bonds. Worked brilliantly. But that doesn't mean it's necessarily going to work going forward under different economic conditions. You've got to figure out what works best for you, and I encourage everyone to do that after they know what all their options are. Remember, retire certain.